No one wants to get it wrong. No one wants to lose, and no one wants to take a hit to their account. But losing is an inevitable part of trading, which you just simply cannot avoid, and it has to be something you learn to embrace. So let's have a look at how to deal with these losses with 5 risk management strategies you can use to make you a more consistently profitable trader. Sometimes you're going to lose, so deal with it. But there are many ways that we can remain profitable, even with these losses. But the very first thing you must do to reduce risk of failure is to find a mentor and learn a strategy. If you're just winging it on your own, then that's pretty risky. I joined Zed Monopoly's community and I learned his strategy, and had I not done so, I most likely would have quit a long time ago. Now, one of the biggest lessons I've learned so far is that you can very easily lose a lot of money very quickly. Thankfully though, I've been paper trading, so I haven't lost any of my own money yet. But even the feeling of losing fake money in a demo account is pretty crushing. So this is something that really needs some attention, because your discipline when it comes to risk management can make you, or it can break you. So here are the 5 risk management strategies you can implement to make you a more consistently profitable trader. Number 1, the 1% rule. Now, the reason why I think most people fail when they first start trading is because they watch traders on YouTube make $500 to $1,000 in just one trade, and they think, wow, that was easy, I'm going to do that. I'm speaking from experience here because that was exactly my mindset when I started. I saw how easy they made it look, and I just thought I could jump in and do the same and get rich. Big mistake. I started off with 5k of trading capital in my demo CFD account, and I was trying to make $500 per trade. Now think about it, that's 10% of my 5k capital. I'd have to put a lot of leveraged money down in order to be able to hit that $500 target. It would have been a lovely return, yeah, but just imagine if the trade goes against me and I end up losing $500 of my 5k account. That's a loss of 10%. Now if that happens just 9 more times, which is perfectly plausible, then my account is wiped and I'll feel very angry and I'll end up hating everyone and will probably just give up thinking it's all a scam and that nobody can make money day trading. I think this is probably the case with the majority of newcomers. Now, imagine instead of trying to make 10% of my capital per day, I try to make just 1%. It sounds a bit pathetic, doesn't it? But if I make 1% of $5,000, that's still $50 in a day. And if I make $50 every day for the week, then that's $250 for sitting on my arse pressing a few buttons for a few minutes. Also, if the trade goes against me and I cut the trade at the 1% figure, then I only lose $50, and that is a much smaller loss to swallow, and I can more easily deal with that emotionally than the huge $500 loss. So by risking just 1%, I can lose the next 99 trades before my account is wiped. And unless you're totally useless, that's pretty unlikely. So how do we implement this 1% rule? Well, that's up to you, as there are a couple of options. The first option is, when placing your trade, you throw all your money in and leverage yourself up to the eyeballs with 100% of your margin requirement, if you're trading CFDs, and when you hit a profit of 1% of your trading capital, you close the trade. Or conversely, if the trade goes against you, you cut the trade manually or with a stop loss order when you hit a loss of 1% of your trading capital. The downside to this is the fact that you're putting down such a large amount of capital, it won't take long for your 1% to be hit, as you're not giving the stock much room to breathe. So as you can see here, if you put down all of your money and you entered here, you are giving the stock no room to move, and this would have resulted in a loss, because the more money you place on a trade, the narrower your margin of error is. Just imagine it's like balancing on a very narrow tightrope. The second and safer option is to widen that tightrope, and to do this you must reduce your position size, the amount of shares you buy, while still aiming for your 1% target. And you can work out how many shares to buy by doing a simple calculation. Now I've got a little spreadsheet going here to help me work out my position size, and I suggest you make one up for yourself. Here's how I do mine. First, I input the total amount of funds I have in my account. Now I'm from the UK, so mine is in pounds, but it works the same in any currency. So let's say I have £5,000. Next, we input our daily target and risk of 1% of that capital. So we times the capital by 0.01, which gives us a daily amount of £50. And you can adjust this amount as you get more experienced, but up to no more than 2%. Now underneath, I have a conversion into US dollars because I only trade US stocks, and so it helps to know the conversion. So to do this, you just simply multiply the pounds by 1.5936, which will give you a rough ballpark conversion. If you're already working in dollars, then you can skip this step. Then we enter the current price of the stock that we want to buy. So say it's $100. And now the important part. We're going to give the stock some room to breathe of 2% of the price of the stock. So if the stock is $100, we're going to give it the space of $2 to move. That means if we buy when the price is at $100, then we aim to take profit when it hits $102. But if it goes against us, we give it room down to $98 before cutting the trade and taking a loss. The benefit of this is that after placing our entry, the price is able to drop down and go against us before it goes back up again in our favour. And so we're allowing it the room to do so without cutting us out of the trade. This formula also works exactly the same when shorting. So based on our profit target, the stock price, and the 2% price movement, we can work out how many shares to buy for this strategy to play out. So we need to divide our US dollar daily target by the 2% price movement, which will give us our total number of shares to buy of this stock. Now all this data is inputted, all I need to do next time is update my capital amount and the price of the stock I want to buy, and everything else will fill in automatically like this. So if we go back to the same example we saw earlier, we can now see with the same entry point and implementing this strategy, our margin of error is much wider, giving the stock much more room to move. And this time it doesn't hit our 1% loss and actually goes back in our favour and we take the 1% profit. Now if none of that made any sense at all, go and rewind the video. This took me a good while to get my head around, so make up your own spreadsheet and play around with the percentages a bit to see what works out for you. And test it out with the demo account only. But really it's the mindset of giving the stock room to move and the mindset of having a small and modest daily profit and loss target. That is what really works. And it might seem like using this risk management strategy will take you forever to reach your dreams of being successful, but it's the only way. And if you don't implement risk management like this, you will never get there. So that's just something you need to come to terms with. And going back to when we watched the experienced YouTubers making $500 to $1,000 each trade, just remember, they have got a very large trading capital that they can put down in order to make those big trades. And so the $1,000 profit we're seeing them achieve is probably 1 or 2% of their capital. So it's all relative. So if you can be successful and consistent in making 1 to 2% per day and just build and build, over time you will be able to make those big trades yourself. But you have to start small and slowly. Risk management strategy number 2, taking profits and cutting losing trades. Now something us traders seem to do, which is a weird thing, but really common, is to cut a winning trade quickly, but hang on to a losing trade for ages. Why do we do this? It's f***ing crazy. But we do it because when we have money, we're so frightened of the disappointment of losing it. And when we're losing money, we're hell-bent on getting it back. We're all guilty of this. And it's just one of those things that we need to go through, experience, recognize, and try and work on. If you're cutting winning trades early, then it's not the end of the world. Green is green after all. But if you're letting losing trades run against you with the hope that it will somehow turn around and magically go back in your favor, then this is something that needs to be addressed. Sometimes we go from being in the red to being back in profit again, and when that happens, it feels great. And we feel proud of ourselves for being brave and for holding on, and we think we've got it all figured out, when really, we just got lucky. The simplest way to deal with a loss is just to be humble and realize that you timed your entry wrong and that you need to cut the trade sooner rather than later. And the longer you hold on to it, the more you will end up losing, and the more you will get angry and frustrated at the market and the world and everyone in it. So just cut the trade, take the loss, consider it a business expense, and try again tomorrow. And feel proud of yourself for being brave and taking a small loss, as opposed to trying to be a smart ass and taking a big loss. If you're not strong enough to do it manually, then place a stop loss order so that if the price hits that level, you'll automatically be exited from the trade. I remember I heard somebody say once, when you take a loss, it's just like the market has taken your money temporarily. Just like you've put money in a bank for a couple of days and you're going to get it back later. Risk management strategy number 3, overtrading and revenge trading. This is a tough one. If you lose a trade, all you want to do is get back at the market for taking your money and recover your losses. But if you can be really strict with yourself and only make a maximum of 2 trades per session, then you will automatically be implementing good risk management. And as you are only allowing yourself no more than 2 trades, you will naturally be more laser focused on timing the perfect entry. You know, statistically, the more trades you make, especially if they are after a losing trade, then the more likely you are to lose again. And then it's just a downward spiral to the bottom. And the more you trade, the more fees you're going to rack up with your broker as well. So if you've had a string of losing trades and you add the commission fees on top, well, you get the message. One of the best pieces of advice I heard on this topic was from Lockstock Tom, who said he had to physically switch his computer off at the wall to avoid himself overtrading. And I do it myself now. I just shut my laptop and I go off into another room, or even leave the house if it's that bad. Risk management strategy number 4, record your trades. A great way to figure out where you're going wrong, or right for that matter, is to record your screen when trading. I have recorded every single trade I've made for the past 2 months, and it is so helpful to look back on with the benefit of hindsight. You can see where you could have made a better entry, or see where you should have taken profits but didn't. And once you start to build your own library of live trades that you've made, you can start to spot patterns in your own behavior, or maybe patterns in the chart, who knows. But it's something I highly recommend everyone to do. You must also keep a journal of all your trades and take note of whether you won or lost, by how much, what happened, how you felt emotionally, what you could have done better, and keep a running weekly total of your profit and loss and your percentage gains. Once you have this record, you'll be able to see your progress right in front of your eyes, and you'll become your own teacher by being able to look back on what your strengths and your weaknesses are. This is how I keep a trading journal. So in this first column, I've got the date, and next to it is my opening capital of $5,000. Next one along, I put the name of the stock, then if it was a long or short position, and then if it was a win or a lose. Next I put in my notes, and this should be details of why you entered, what happened, what you could have done better, etc. Next, your P&L, how much you won or lost by. Then the amount of fees incurred, if any. Make sure to always add a minus sign here. Then the spreadsheet works out the closing capital and the percentage gains. And lastly, the gross profit. You'll need a few spreadsheet skills for this, so Google formulas for Excel or numbers if you're unsure. When you come to the next trading day, just copy and paste everything so you don't have to fill out the formulas again. To put in a losing trade, remember to add a minus sign in the P&L column. Once you get your trading journal going, you will be tweaking and perfecting it to your taste for ages until you get it just right. Then you might even want to start creating graphs from the spreadsheet tracking your progress. It's all incredibly helpful and motivating, so get yours going today. And my final risk management strategy, number 5, is keep it simple. Try not to overcomplicate trading. It doesn't need to be difficult. You don't need to be looking at 6 screens at once. Stick to one stock or index per day and focus on it. And forget about indicators, okay? Indicators will only distract you, and they don't really offer any real helpful information that you actually need when day trading and scalping. All the information you need is reading the price action from the candlesticks and drawing your support and resistance lines. Forget about everything else. I think a lot of new traders think that indicators look cool and that it makes them think they know what they're doing and that they're going to get some sort of secret message telling them exactly what to do and make a successful trade. But you can easily make the wrong decisions based on something an indicator is telling you, because indicators are laggy and they're based on what's already happened. Price action is what's happening right now, in the moment, and that is all you need. If indicators work for you, then great. But if you're starting out, then don't overcomplicate things and just get used to reading the price action. EMAs, I know, can be very useful, but personally they have only made me make wrong decisions. So for now, turn off your indicators, keep it simple, and stick to the price action. Lots to think about there, so let's have a quick recap. Put your dreams of becoming a millionaire aside and focus on steadily making 1% of your capital per day, and risk no more than 1% of your capital as well. If the trade goes against you, then pull the plug before it takes more than 1% by placing a stop loss or closing it manually. As you get more experienced, you might want to increase your target to 2%, but don't go any higher. Create a spreadsheet to work out your position size based on your trading capital, risk amount, and stock price, giving the stock room to breathe. Discipline yourself not to overtrade or revenge trade. close your computer and go and do something else. The market will always be there tomorrow when you have a fresh head. And start getting into the habit of recording your trades by screen grabbing your trading platform, and keep a detailed journal of every trade you make. And finally, keep it simple. Well, I hope that helped. Trust me, it took me a while to get my head around all this stuff, but it'll make sense eventually. And if you have your own strategies or advice, please feel free to share them in the comments. And you know the deal, like and subscribe if you found this helpful. I've almost hit 100 subscribers this week, and I can't believe it. I'm so chuffed about that. I didn't know anyone would actually be watching these videos, so I'm really grateful to those first 100 subscribers. Let's try and make it to 1,000. All right, stay safe out there, manage that risk, and thanks for watching. I'll see you next time.